All right, so today I wanted to make a video about what is my favorite semiconductor stock. I think that there's a lot of good semiconductor stocks. The only problem is right now, well, not the only problem, but the biggest problem is right now we are in a period to where growth stocks are not doing very well, and until rates go down, we're probably going to stay in that period. So right now, I think we need to be looking more at the value side of things. Now, again, I don't necessarily think that Broadcom is a traditional value stock, but compared to NVIDIA or, I mean, even Taiwan Semiconductor to a degree, I think it is a value stock, right? But again, compared to the vast majority of semiconductor stocks, yeah, it's a very good company for many reasons. I'm going to get into it here. Again, very simple. Earnings yield, you're looking at about 5%, which is good because a lot of these semiconductor stocks, you're looking at like 1, 2, 3%. You want your earnings yield to be above the 10-year, preferably every single treasury yield, but especially the 10-year. Again, dividend right now, you're looking at just under 3%, which is very good. Again, for a semiconductor stock, most of them don't even pay dividends, let alone an actual solid dividend. If we get into what analysts are actually fairly bullish on this company. But again, analysts are always going to lean towards the bullish side. If we get into the dividend, this is one of the main reasons, if not the main reason, why it's my favorite company, favorite semiconductor stock. Again, dividend compounded growth rate over the last 5 years, 18.5%, which is very nice. That's very nice growth. And again, the free cash flow payout ratio is only about 42%. So they technically could be paying like a 6.5–7% dividend if they really wanted to. Obviously, I don't think that would be a good idea, but they could if they wanted. If we get into the financials here, again, pretty good balance sheet. They've started paying down debts over the last couple of years, which is good to see. They've been buying back shares since 2017, which is also very good to see. They have also bought back a record amount of shares last year. If we look at the free cash flow, this is like perfect, not perfect, but damn near perfect, right? I mean, look at this growth is just phenomenal. Like you go back 2013, 486 million, 2022, 16 billion, right? So they've more than 10x that, 20, 30x that free cash flow over that period of time, which is exactly what you want to see. Again, of all the, when it comes to the pricing of stocks, over the short run, nobody can tell what's going to happen. But over the long run, if a company's continuing to grow their free cash flow, the price is like 99% chance it's going to go up. And if it's going up faster than the market, it's going to go up faster than the market. So again, I don't know what's going to happen over the short, whatever, next month, 2 months, 3 months, even 6 months to a year. But over the next decade, assuming this trend continues, it's going to slow down. But assuming it continues, this company is going to continue to outperform the market. I mean, if we go look at that and compare it to the S&P here, let's just do that quickly. Again, this is a company that's absolutely destroyed the S&P going back to 2009. Let's just go even like 5 years, right? Still easily beat the S&P. The S&P is up 75%. This one's up, about 200%, which is amazing, right? To double your money in 5 years, that's amazing. Again, getting back into the financials here, let's look at the metrics. This is another reason to love this company. Again, very nice all around. Again, look at the free cash flow margin. Again, consistently going up. That's exactly what you want to see. Same goes for operating cash flow. Again, return on equity was an all-time high last year. That's very good to see. Same was for return on invested capital. Again, free cash flow per share. Again, same as that free cash flow. Again, look at that chart. Just perfect chart, right? Current ratio is also solid. Again, it's over 2, right? Again, so this company, it has a solid balance sheet. Again, not the best you'll ever see, but it's very solid. Again, it is projected to grow next year, which again, a lot of companies aren't, right? So that's a very good thing to see. If we're looking at financial health, again, that's pretty good. Growth, pretty good. Returns, very good. Profitability, again, it checks pretty much all the boxes in my opinion. And here's another very important thing that I think is very important that I've talked about before. Again, it's not super expensive, right? It's not super expensive. Price to free cash flow of 14.2, sorry, 14.3. That's very reasonable. PE of 20, right? I mean, compared to the market, that might be a tiny bit expensive, but for a tech stock, a semiconductor stock, it's pretty good. I mean, let's compare it to NVIDIA here. Let's compare it to NVIDIA and see what the numbers look like. Again, NVIDIA I don't think pays a dividend, so we're not going to be able to do that. Or, sorry, it does pay a dividend, very small, about 0.1%. So it's virtually not even relevant. Again, financial health, NVIDIA actually looks like it has a little bit better of a balance sheet. But again, the growth numbers, NVIDIA is projected to go down next year. Broadcom's projected to grow very well. Profitability, Broadcom is better. Returns, Broadcom is better. Again, NVIDIA has a 86 price to free cash flow, 70 PE. So again, this is a company that's trading very rich, right? So let's compare it to Taiwan Semiconductor, probably a better comparison, and especially considering Taiwan Semiconductor pays a little bit better of a dividend. Again, analysts are a little bit more bullish on Taiwan Semiconductor. Dividends is a lot lower for Taiwan Semiconductor, although it is about 0.5%. Again, Broadcom's growing that dividend quite a bit faster, and the payout ratio is better for Broadcom. If we look at the financial health, again, Taiwan Semiconductor is a little bit better. Growth, Taiwan Semiconductor is better. Profitability, comparable, not that much of a difference. Returns, basically the same. Valuation, again, price to free cash flow, Broadcom's better by quite a bit, right? PE, it's worse, but I'd say price to free cash flow is a better metric. And again, the growth of Broadcom has also been better, right? PEG ratio is also better for Broadcom. So again, I think that over the long run, I think the semiconductor space is going to do all right. But the growth we've seen in like 2020, 2021, that bull run, like that's not going to happen again. Like that's going to be that's a once in, a 20 or 30, 40, 50 year period. Like some of these stocks went up like 5x, 10x, right? So that's just not going to happen again, right? But I do think that, I mean, if I was ranking my companies that I most wanted in the semiconductor space, I would probably say Broadcom is number one, Taiwan Semiconductor is probably two. But again, we need to be very vigilant if you're looking at Taiwan Semiconductor. If the China-Taiwan tensions were non-existent, I would rather have Taiwan Semiconductor. But when you factor that in, I would say Broadcom. I think if you could get NVIDIA or some of these other ones at a fair price, yeah, I would go for them. But the problem is that those ones are trading at such high valuations that, AMD as well. Like, let's see where AMD is at here. I mean, AMD is not even as profitable, and they're quite a bit more expensive. I mean, they're literally more than double as expensive. So that's the thing. I mean, but it's gone up 500% in the last 5 years. Again, so this is what I'm trying to point out here is that value is going to be better than growth, in my opinion, even if the Fed lowers rates. Like, we're not going to get like zero, like these rock bottom rates again, at least in the near future. I think that they're going to lower rates in the next year or two. I'd be very surprised if they didn't. But going down as low as they did, I would also be very surprised if they go that way, right? Because, I mean, that was like historically low interest rates, right? So, and this is the problem with a lot of these growth tech kind of companies, is that they rely on these low interest rates because a lot of these companies aren't even making money, right? And if they're not even making money, well, how do they grow, right? They need to grow through debt or dilution, right? And again, if you're like, in my opinion, and I don't think this is overly, I mean, it shouldn't be overly controversial, right? You should never buy a company that's taking on excessive debt or is diluting excessively. Like if that's a normal thing, 100% of the time, there's odd times to where I could see it, but virtually never, right? Virtually never is that a good idea. And that's a mistake that a lot of people have learned the hard way over the last year, is that people bought these companies that traded at these super high valuations. I mean, Tesla's another good example of this. Again, I think Tesla's a solid company, but they're way too expensive. And they've gone down a lot, and they're still way too expensive, right? I mean, I think that I don't even know if Tesla's worth $100 a share right now, right? And again, like I say, not that I think it's a terrible company. I think it's a solid company, but again, they're just so expensive. Same goes for some of these other ones, AMD, NVIDIA, right? They're very good companies, I think. Like I think NVIDIA and AMD are arguably better than Tesla, right? But they're so expensive, right? And again, in a higher rates environment, companies that are trading at high valuations are going to get killed, right? Those are the ones you're going to lose the most money in. The companies you want to be in are the ones that are priced, that are discounted the most, right? And I think a company like Broadcom is a great example of that, right? Again, 14 price to free cash flow, a 20 PE, like that is very reasonable, like very reasonable. Right? I mean, let's see. Let's just go into the free form and see where it's traded at, like over its periods here, or over time. Sorry. I mean, if we go back, let's even go back like 10 years here. Average price of free cash flow is 20. Right? The lowest it's ever got is 8. Right? And that was during the you know what crash. Right? So again, I mean, before that, it never went below 10. Right? So you're getting it not far off its lows, right? Not far off its lows. So this is what you want to look for. I mean, let's compare it to NVIDIA, didn't put that in right, just to see, right? So NVIDIA was quite a bit cheaper. Let's go back even like the last 5 years, just for it to be a more fair comparison here. NVIDIA, the average price of free cash flow has been 56, right? Broadcom has been 15, right? So Broadcom is a little bit below that average, which is exactly what you want to be. In my opinion, you don't want to buy a company above its average over the last 5 or 10 years, right? Because what you're doing is you're buying a company at a premium, right? You don't want to buy companies at a premium. You want to buy them at a discount, right? And again, price of free cash flow of 86, like that's insane. That means that the company's going to have to grow a crazy amount just to fit its current pricing, let alone its future, right? The lowest it's ever got was 24. Like I would pay that in a heartbeat. I'd probably pay 30, right? Maybe 35, but that's as high as I would go, right? And it's nowhere near that, right? So this is something that people need to figure out, because a lot of people got burnt, and a lot of people will continue to get burnt paying too much for these companies, right? So anyway, that's what I wanted to bring up today. If you liked the video, hit that like and subscribe, and stay tuned for more.